Welcome to the video on navigating the hidden tax bomb of RSUs and stock options. In this video, we will explain how pre-IPO equity can transform your finances, but also create unexpected tax consequences that can derail plans such as contributing to a Roth IRA. We will focus on the timing of income recognition, its effect on modified adjusted gross income, and how to plan for RSUs, NQSOs, and ISOs, especially around an IPO. Let's begin by outlining what we will cover. Here's today's agenda. First, we will establish why timing matters for equity compensation. Next, we will separate the two taxable events that cause confusion. Then we will dive into RSUs, highlight the double trigger and its impact, and contrast stock options, including NQSOs and ISOs, with AMT implications. After that, we will connect these events to your modified adjusted gross income and Roth IRA eligibility. Subsequently, we will share a practical action checklist and walk through example scenarios. Finally, we will include short quizzes to reinforce the key concepts. Before we proceed, this content is educational and not tax, legal, or investment advice. Tax rules, income thresholds, and company-specific practices can change and vary by jurisdiction. Therefore, consult a qualified tax professional or financial advisor to evaluate your individual circumstances before taking action. Timing matters because equity-related income is recognized at specific events that can suddenly increase your ordinary income and your modified adjusted gross income. This spike often occurs around an IPO when RSUs with a double trigger vest, or when options are exercised. Consequently, an unexpected increase in MAGI can render you ineligible for a direct Roth IRA contribution for that year. Let's separate the two critical taxable events. First, the RSU fair market value at vesting, or the non-qualified stock option spread at exercise, is ordinary income and increases your current year MAGI. This is taxable event 1. Second, selling the shares later triggers capital gains or losses, which is taxable event 2 and is separate from the initial MAGI spike. The key insight is that the act of vesting or exercising controls your immediate ordinary income and MAGI, whereas the sale affects capital gains treatment later. Restricted stock units often use a double trigger structure, requiring both service-based vesting and a liquidity event, such as an IPO. When the liquidity event occurs, the second trigger is satisfied, and the fair market value of the vested shares is recognized as ordinary income and added to W-2 wages. This recognition can significantly increase your MAGI for that year. Importantly, you owe taxes on this value even if you do not sell any shares. Company withholding may be insufficient, so anticipate and plan for a potential tax shortfall. For non-qualified stock options, the spread between the market price at exercise and the strike price is treated as compensation and increases your ordinary income and modified adjusted gross income. For incentive stock options, while regular income tax may be deferred until sale if holding requirements are met, the exercise can trigger the alternative minimum tax in the exercise year. Around an IPO, when valuations are high, exercising options can dramatically increase your current year income. Therefore, model the tax effects before exercising. This timeline illustrates the life cycle of equity compensation. We begin with the grant. Next, RSUs accumulate service-based vesting while options vest over a schedule. At the IPO or other liquidity event, RSUs with a double trigger recognize income at the fair market value of vested shares, which is taxable event 1, and increases MAGI. Then comes the exercise decision point for options, where the NQSO spread is ordinary income and ISO exercises require evaluating AMT exposure. Following that, the lockup period may limit your ability to sell. Later, when you actually sell shares, you realize capital gains or losses, which is taxable event 2. Finally, during tax filing, RSU income appears on the W-2, sales are reported on Form 1099-B, and AMT is evaluated on Form 6251 for ISO exercises. Roth IRA eligibility depends on modified adjusted gross income, RSU vesting, and NQSO exercise can increase MAGI beyond the annual thresholds, disqualifying you from making a direct Roth IRA contribution. While ISO exercises may not increase regular taxable income in the same way, they can trigger the alternative minimum tax and still create cash tax obligations. If you exceed the MAGI limit, a backdoor Roth IRA may be an alternative, but you must consider the pro rata rule on existing pre-tax IRA balances. Here are illustrative 2024 MAGI thresholds for direct Roth IRA contributions. For single filers, a full contribution is generally allowed below $146,000, phasing out between $146,000 and $161,000, and disallowed above $161,000. For married filing jointly, a full contribution is generally allowed below $230,000, phasing out between $230,000 and $240,000, and disallowed above $240,000. For married filing separately, the phase-out is from $0 to $10,000. Always verify current IRS limits as they change. Comparing RSUs and stock options clarifies planning priorities. RSUs create ordinary income at vesting based on the fair market value, and typically show up on the W-2, increasing MAGI immediately, especially under a double trigger at IPO. There is no exercise decision with RSUs, and taxes can be owed even without selling. Stock options, on the other hand, involve an exercise decision. For NQSOs, the spread at exercise is ordinary income and increases MAGI. For ISOs, the exercise can trigger AMT and requires attention to holding periods to obtain favorable tax treatment on sale. Additionally, sale timing affects whether gains are short-term or long-term. Here is a practical playbook. First, estimate your MAGI for the IPO year as early as possible, incorporating base pay, bonuses, RSU fair market value at vest, NQSO exercise spreads, and other income. Next, stress test scenarios with varying IPO prices and exercise timing. Then, coordinate withholding by adjusting your W-4 or setting aside cash to cover a potential shortfall from RSU withholdings. Plan option exercises deliberately, avoiding large same-day exercises that create a spike, and consider staged exercises if feasible. For ISOs, run AMT projections before exercising and consider whether early exercise before liquidity is permitted and appropriate. If your MAGI is too high for a direct Roth IRA, consider a backdoor Roth IRA while understanding the pro rata rule. After the lockup expires, adopt a structured sale plan, such as a 10b5-1 plan, to manage risk and taxes. Finally, document all grant and tax forms and engage a tax professional experienced with equity compensation and AMT before the liquidity event. Here is a concise Markdown style reference. First, taxable event 1 increases MAGI, the RSU fair market value at vest, and the NQSO spread at exercise. Second, taxable event 2 concerns capital gains or losses when you sell shares later, after any lockup. Finally, a rule of thumb. If your MAGI exceeds the applicable limit, a direct Roth IRA contribution may be disallowed for that year, so consider a backdoor Roth if appropriate, while being mindful of the pro rata rule. Quiz time. The question is, which event directly increases your current year modified adjusted gross income? Option A, selling shares after the lockup. Option B, RSU fair market value recognized at vest. Option C, long-term capital gains on a sale. Option D, dividend reinvestments only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. RSU fair market value recognized at vest is ordinary income and increases your current year MAGI. Selling shares later creates capital gains, which is a different tax event. Next quiz. Which statement about incentive stock options is most accurate? Option A, ISO exercise never creates tax in the exercise year. Option B, ISO exercise can trigger the alternative minimum tax, even if regular tax is deferred. Option C, ISO exercise always increases W-2 wages like non-qualified options. Option D, ISOs are taxed only when sold and never affect AMT. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. ISO exercises can trigger the alternative minimum tax in the year of exercise, even though regular tax may be deferred until sale if holding period requirements are met. These are the key takeaways. First, taxable event 1 RSU vesting or NQSO exercise drives your current year MAGI. Second, selling shares later affects capital gains rather than the initial MAGI spike. Third, double trigger RSUs at IPO can cause a substantial increase in W-2 income. Fourth, NQSOs increase MAGI at exercise, while ISOs can trigger AMT. Finally, elevated MAGI can block direct Roth IRA contributions, so consider alternatives such as a backdoor Roth if appropriate. To summarize, equity windfalls can be transformative, but timing can create substantial tax surprises. Understand the two taxable events and plan around IPO timing. Model your MAGI early, coordinate withholding, and consider staged exercises. Know the Roth IRA limits and prepare a backup strategy such as a backdoor Roth. Most importantly, partner with a qualified tax professional before your liquidity event. Thank you for watching. If you found this helpful, please like the video, share it with a colleague, and subscribe for more content on equity and taxes. Share your questions and IPO experiences in the comments. We would love to hear your stories and thoughts.